What is the history of Basel Accords regulation? Have you ever wondered how global banking regulations came to be? The Basel Accords are a series of international banking regulations that aim to strengthen the stability of the financial system. Their story began in the 1970s, a time when banks faced significant challenges. In 1974, the Basel Committee on Banking Supervision was formed by central bank governors from the group of 10 countries. This committee was created in response to disruptions in international banking markets, such as the failure of Bankhaus Herstatt in Germany. The goal was to improve banking supervision and cooperation among regulators worldwide. The first major framework, known as Basel I, was introduced in 1988. This came about partly due to concerns from the United States debt crisis in the 1980s. Basel I focused on credit risk and introduced the concept of risk-weighted assets. Banks were required to hold a minimum capital amount equal to 8% of their risk-weighted claims. This helped align capital requirements with the actual risks banks faced. In 1991, Basel I was amended to clarify provisions related to loan loss reserves. Over time, it became a global standard, adopted by many countries beyond the original group of 10 members. As the banking landscape evolved, limitations of Basel I became clear. In 2004, Basel II was developed to address these shortcomings. It introduced a more sophisticated framework based on 3 pillars: minimum capital requirements, supervisory review processes, and market discipline through enhanced disclosure requirements. This accord aimed to improve risk sensitivity and encourage better risk management practices. The global financial crisis of 2007-2008 revealed weaknesses in banking regulation, especially regarding liquidity and leverage. In response, Basel III was introduced starting in 2010. Basel III strengthened capital requirements by raising both the quantity and quality of capital banks must hold. It introduced new measures like the leverage ratio to limit excessive borrowing and the liquidity coverage ratio to ensure banks can meet short-term obligations. Throughout this journey, the Basel Accords have evolved from focusing on simple capital ratios to a comprehensive framework that includes risk sensitivity and supervisory oversight. They play a central role in harmonizing banking regulations internationally and promoting the soundness of the banking system. Today, banks worldwide implement these accords by calculating their risk-weighted assets and maintaining required capital buffers. They also submit to supervisory reviews, ensuring they can absorb losses and continue operating during financial stress. The Basel framework continues to adapt to new challenges, including cyber risks and climate-related financial risks. The history of the Basel Accords reflects a continuous effort by international regulators to respond to financial crises and market developments with increasingly sophisticated rules. This evolution has shaped modern banking supervision and contributed to global financial stability.